Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Blade stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Blade Air Mobility, or Blade for short, allows users of its app to book seats on scheduled flights throughout the Northeast and West Coast of the US. Also, members can arrange private charter flights. It has over 200,000 users and 40,000 annual flyers. The company offers flights by targeting popular driving or flying destinations. For example, instead of spending 4 to 5 hours driving from New York City to the Hamptons, just take a 30-minute jet ride with Blade. Instead of flying from LA to Vegas by going into a crowded airport with delays and stress, go on a private jet for less money. Traffic congestion is getting out of hand, with the average car speed in New York City going from 9.1 miles per hour in 2012 way down to 4.7 miles per hour in 2019. Soon we're going to be all walking to work because it will be faster than driving in bumper-to-bumper traffic. Traffic is even worse overseas in cities like Mumbai and Tokyo. To give you an example of their services, if you want to go from New York City to Philadelphia by car, that will take 3 hours. By train, it is slightly over 2 hours, but using Blade, it's slightly over 1 hour. The cost to take a train and Blade are the same. Blade is also cheaper and faster than a traditional flight. The reason Blade is cheaper than a regular flight is because Blade partners with a lot of companies that fly private jets, and most private flights have less than half of the seats filled. For example, the average 6-seat helicopter flight carries 1.7 passengers. The reason these small planes are not filled up is because these smaller companies don't have the resources and marketing dollars to find people to fill up their flights. The company plans to transition to a fully electric fleet. This will help lower operating costs, which in turn reduces the prices for its customers. Noise is a big problem with gas-powered jets, especially if the landing area is near many homes. Electric jets are much quieter and, of course, produce zero carbon emissions. The company does not own, lease, or operate its own aircraft. Everything is done through third parties. Same thing with Uber. Uber does not own any cars. The people who drive the cars own them. This is like Uber for planes. It was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. The name of the SPAC that acquired Blade is Experience Investment Corp. The deal was closed in May 2021, and Blade received cash proceeds of $365 million. The company is headquartered in New York, New York. It was founded in 2014. It trades on the NASDAQ. Let's get started with the model. This is a small cap company, 712 million market cap. They're trading at $10.26 a share, and they have 69 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow each year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is the sales for the company, and that doubled from 20 million to 40 million. This is the company's income statement, and these numbers are as of 6/30/2021. It shows you the quarterly numbers and the trailing 9-month numbers. So in the second quarter of 2021, they had 13 million of revenue. If you annualize that, that's about $52 million. They spent 10 million in cost of revenue versus 2.8 million the prior quarter of 2020. The higher cost of revenue was driven by an increase in volume of operating flights. That's what you want to see, is more flights. But of course, every flight, it costs them money. It's not as scalable as making a product, where you can make millions and millions of those products, and the cost per product goes down. Below that is software development. That's 213,000, so that seems pretty consistent from last year, 220,000. They spend a lot in G&A, 9.8 million compared to 1.6 million last year. Their G&A expenses for the 9 months ended 6/30/2021 was 18 million. There was an increase of 5.6 million in stock-based compensation. This is when you pay your employees with stock. Also director and officer insurance of $1.2 million, and then professional fees of $3.8 million from going public. In the past 9 months, they spent $2.1 million in selling and marketing, which is pretty similar to 2020. So it seems like the company spent less money than last year. Last year, it spent a lot of money due to COVID restrictions. So since they're not bringing in a lot of revenue at this point, they have operating losses. But I'm sure once their revenue gets up to $100 million annually, we may start to see some profitability. In the second quarter of 2020, they had 25 million shares outstanding, and that doubled to 52 million in the second quarter of 2021. This is what happens when you go public. More shares are outstanding. Now they're up to 69 million currently. This is the company's statement of cash flows. This line, cash flow from operations, that's the same as net income converted to cash. The way you calculate cash flow from operations, you start with net loss or net income, and then you have to add or subtract the non-cash items on the income statement, and that's how you come up with cash flow from operations. So in the second quarter of 2020 and the second quarter of 2021, they lost $10 million of cash flow. They invest very little in PP&E, which is capital expenditures, only $230,000, because they don't have to buy any planes. That's all done through the third parties. Those companies own the planes. Blade just has agreements with those companies to get people on their flights, and Blade gets a fee for that. The company raised $120 million in PIPE. That's private investment in public equity. This is when an institution buys equity in a public company. This is a lot faster, usually 2 to 3 weeks. If the company did a secondary offering, meaning anybody could buy the stock, including me and you, that could take a couple of months, maybe longer. It's much quicker to do a PIPE deal, you get the money faster, but you usually have to give a discount to that institution for buying all the shares. So of course it does dilute the current shareholders. But if a company needs money fast, this is a good way to do it. This is the equity section of their balance sheet. They have $300 million of equity. They raised $365 million from selling their business, and they lost $68 million from running their business. Let's look at the capital structure. They have $297 million of equity and only $400,000 of debt. So they're 100% equity, and they have lots of cash on their balance sheet. Their weighted average cost of capital is 7.8%, and that's the middle whack according to Finbox, and that's a discount rate we're going to apply to the future cash flows. We estimated 6 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 6, that's $612 million. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $432 million. We divide that by 69 million shares. And we get a calculated stock price of $6.22. They're trading at $10.26, so they're trading at a 65% premium. It's a sell according to the model. The average analyst projects their revenue to grow 41%. So I grew their revenue 41% for the next 4 years. That's how I got their future revenue estimates. And the average company converts 10% of their revenue to free cash flow. So I converted 10% of their 2024 through 2027 revenue into free cash flow. I gave them negative for the next 2 years because I figured they'd still be unprofitable at that point. 5 analysts priced this stock and the average price target was $15. You can tell this was a SPAC because it was trading at $10 for a few months. And then once the company announced they were going to acquire Blade, the stock got close to $20. And this is before the acquisition. The deal didn't go through until May. So you can't wait until May to buy the stock. You have to buy it way before that. Because you can see there was a really big sell-off. Then the stock moved up and down for a little bit. It's now trading pretty much where it was when it was a SPAC last year. The 52-week low was 641. The high was about 20. And the stock is trading above its 50-day and 200-day moving average. 1 million shares have been traded on average the past 3 months. Of the 69 million shares outstanding, 43 million are on float. Half the shares are held by institutions, and 7.5% of the shares are shorted. According to this website, their short percentage was 7%. Now it's up to 12%. So a lot of people think this company will fail. Most recently, HBK Investments shorted 150,000 shares. Ionic Capital shorted 700,000 shares a couple months ago. If you invested $10,000 into this company when it started trading in 2019, you'd be at $10,500 today. The biggest shareholder is KSL Advisors, 13%. Then HG Vora, Digital Bridge, the founder and CEO, owns 7%. Then Kathy Wood's ARK Investment owns 5.7%. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is a little high, but it's not too bad at 8.9. That's better than the market average. And they have a really good price to book of 2.4 since they have so much cash on their balance sheet. They have a really high current ratio and quick ratio. They have $333 million of cash on their balance sheet. So the company is really well capitalized. They may acquire other companies since they have so much cash. The best way to look at ratios is to compare them to companies in the same industry, but I really haven't done many companies in the same industry. Up is a good comparison, but I don't have much information on Up. The only info I have on Up is their market cap, and Blade is half the size. So to summarize, I have them trading at a 65% premium, but I do like their business model because they take no operational risk. They just have to connect the customer with the flights. So it's mostly just customer service for this company. All the operational risk is assumed by the company that owns the aircraft. So it is interesting the company's founder has found a weakness in this market, and he's capitalized on it. And the costs aren't that high because a lot of these planes would be empty, so he's getting them at a discount. That's why the cost is similar or even less than a regular plane ride. Plus, you don't have to deal with that headache of driving to the airport in traffic, then waiting at the airport with all those people. I'm not sure if I would invest in this company. Maybe in the future. I gotta look at their financials the next few quarters. I rank their free cash flows 1 out of 10, their revenue 3 out of 10, and the ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.